Good evening, ladies and gentlemen. My name is Konrad Bobilak, and welcome to tonight's webinar, Melbourne's property market, what's hot and what's not in 2016. And I'm really excited to be here tonight on this very cold Melbourne night. So we're going to have a lot of fun. There's going to be a lot of information that's going to be covered tonight. Specifically, I'm really excited about sharing some of the information with you that's very current. And the reason that is because I'm in the market every day as a real estate agent and as an investor. So you're going to learn a lot of distinctions about what's happening in the Melbourne property market that you might not necessarily read in the media or find out by watching the TV. Definitely there's a bit of a disclaimer there. I can say that personally, all the information that I'll be sharing with you tonight is accurate. I'm a real estate agent. I can give you opinions about the market, and most of the information that I'll be discussing with you tonight is backed up by statistical data, and I'll give you the sources of all my information as well. So what we're going to learn tonight on tonight's webinar is where are we currently in the Australian property cycle in terms of all the major capital cities as well as regional areas, which is very important for you to understand as a property investor. And a lot of theories are structured around getting the timing correct when it comes to property investing. And I think getting timing correct or trying to time the market is a complete waste of time. From a practical perspective, I've never seen anyone pull off this successfully, mainly because it takes 3 to 4 months to actually transact in the market, meaning that by the time you find the property, it might take you a couple of months to locate a good property. Then you sign the contract of sale subject to finance 21 days. Then the contract of sale goes unconditional. There's another month. And then you have a settlement in 60 or 90 days. So you've got 3 or 4 months every time you transact. So reality is, some transactions will take you up to 6 or even 7, 8 months. So trying to time the market is virtually impossible and impractical from a very tangible perspective. Most investors that I look after that are very successful, that have large property portfolios like myself, they pretty much buy property as much as they can, and that means at the best of times they're transacting 3, 4, 5 times a year. The most active I've ever been as a property investor in the last 20 years is I've done 5 transactions in 12 months, and I was doing paperwork virtually every day, every week. So for those of you who've got property portfolios, you would understand what I'm talking about. Also, I'm going to talk about the best areas to target in Melbourne, and we're going to talk about the best suburbs to target in terms of capital growth potential. And I'm going to give you a bit of history about the property market in Melbourne, and I'm going to show you specific areas and suburbs and name those suburbs and give you the highest yielding suburbs, the fastest capital growth suburbs. And also I'm going to talk about areas you should avoid like the plague and never invest in. Avoid them like a Tina Arena concert. Also, I'm going to talk about the best types of properties to invest in Melbourne within those areas, because the reality is within different areas, different properties work and different properties don't work. And when it comes to property investing, you have a choice of 3 types of properties that you can buy in an area. You can buy a detached house or a semi-detached house. You can buy a townhouse, or you can buy an apartment. And some do well in some areas and some fail miserably in other areas. So I'm going to show you areas where you've got to be really careful, especially when it comes to buying apartments. In fact, most areas in Melbourne, when it comes to buying apartments, just don't work, and apartments don't perform very well. I'm going to give you the exact list of suburbs where apartments do exceedingly well, and I'm going to talk about the methodology and the parameters you need to be aware of when identifying those areas. And I'm going to talk about areas where apartments fail miserably. And when I talk about failing miserably, I'm talking about over 10 years they fail to keep up with inflation. And because they're performing under inflation, you're actually losing money. And I'll show you specific examples of apartments that have actually had no capital growth over the last 10 years. So I'm talking about 0 capital growth, and those apartments were valued by an independent valuer at 2 different intervals in time. So this information is 100% accurate. Because people say that property always goes up in Melbourne, or it's very difficult to lose money in property in Melbourne. That's absolutely incorrect. You can lose money in property in Melbourne without even trying. If you target the wrong areas and you buy the wrong type of property, and more importantly, if you have the wrong structure as well set up, you can lose money on property very easily, especially considering agents' commissions, stamp duty and transactional costs associated with acquiring a property and then selling the property, capital gain tax. So, you know, most investors, they get started incorrectly, end up losing money in property. And that's the reality of the market. By being on tonight's webinar, I'm going to hopefully give you some insight and key distinctions that will make you a successful property investor. And I'm actually going to share stuff with you that took me really decades and sometimes 2 decades to learn and acquire. I'm also going to talk about what the experts are predicting for the next 3, 5 and 10 years in terms of different areas of Melbourne, and specifically where the growth will be and where there'll be in areas where there's an oversaturation point of properties as well. And also I'm going to give you an insight on how you can develop a clear 10-year investment plan, which is probably the most important part when it comes to investing, is to identify exactly where you want to achieve, lock in that destination. Just like going to traveling in your car, going to a destination you've never been to, you lock in your address in Navman, and that's how you get there. So locking your destination and having a clear plan of attack is probably the most important thing you can do as an investor. I'm going to show you at the very end how you can do that yourself and how you can start developing your own plan. As a special bonus section, just to reward you guys for being here tonight, I'm going to give you absolutely free my real estate investing fast track weekend online video home study valued at $497, which is really cool. So you got to stay tuned right to the end of the webinar, and I'm going to give you that for free, and I'm going to show you how to can access that tonight and start watching it. And that's an event that was recorded a couple of years ago. It's 3 speakers, 2 days of contents, and I've edited down the contents to 10 hours of real estate education delivered by some of the sharpest minds in finance and real estate in Australia today. Plus you get a 265-page manual. So that's something that I'm going to give you at the end for free, no strings attached, just because you're here. And hey, I can give it away for free, why not? It's my stuff. So a bit about myself, without boring you guys to death. Why should you listen to myself? And some of you have already spent time with me. Some of you have been to my live events in the past. Some of you have read my books. Some of you don't know who I am. So just to give you a bit of background, I've done a bunch of things in my life. I'm currently a real estate agent, and I own a company called Investors Prime Real Estate, and I'm a real estate agent in Melbourne. I grew up in Melbourne. I know Melbourne exceedingly well. I grew up in the suburb of Elwood in the Bayside, and I have done hundreds and hundreds of transactions in Melbourne. I used to also, in a previous life, be a mortgage broker, and I had a mortgage broking company consisting of 13 mortgage brokers. And previous to that, I was working in the banking sector and financial planning and financial services sector. So I've been around kind of finance and property most of my adult life. I'm also the author of Australian Property Finance Made Simple, which is a book that came out last year. It's done really well, and it teaches people basically, it's a step-by-step guide on how to build, structure and automate a multi-million-dollar property portfolio from scratch. It teaches you how to pay off your home loan instead of 30 years in 10 years or less, and a bunch of other really cool things. So if you're interested in getting that, you can check it out. It's all major bookshops, Amazon. You probably get it for $10 on eBay by now. I'm also writing a number of other books as well, which my second book, which will be hopefully will coming out end of this year. I'm pretty lazy when it comes to writing books. I procrastinate big time. But this one is nearly done, and it's called The Australian Property Investing Made Simple, and it's myself and 8 other authors contributing to that book, so which will be a really cool book. Then I'm also writing a book called Australian Property Due Diligence and Research Made Simple, which will be coming out in 2016, probably 17 now, and also another book which is about which is called the Real Estate Millionaire Mentor, where I'm actually mentoring a bunch of investors, and it's a kind of a book that kind of tracks their journey as property investors and exactly what they're doing and why they're buying properties, where they're buying, and what loans they're using to buy those properties with, which is really cool. So stay tuned for those future books that will be coming out and hitting a bookshop next to you or Amazon. Now, there are 4 critical parts that you need to be aware of if you are interested in building a large property portfolio, which is assuming you are, because you're on this webinar with me tonight. The first thing is you've got to have the right investor psychology. Psychology stops investors dead in their tracks from building wealth through property. Now, psychology is just a generalized word. What it really means is It's a number of things, and I'm actually writing a book about it right now. But it has to do with your mindset, and it has to do with your relationship with debt, especially ability to distinguish between good debt and bad debt, which is one of the biggest obstacles that investors have. Most people, if they've been conditioned to be anti-debt, and this is especially for migrants coming from other cultures to Australia, if in your country, and my parents are Polish and we came from Eastern Europe, we had the same psychology, we were anti-debt. You know, my parents used to tell me, if you don't own any money to anyone, you're in control of your life. Never have any debt, son, you know. Where property investing is all about debt structuring, but it's about good debt structuring, and it's about leveraging other people's money in an asset called property. So having the right psychology is going to stop you from investing. And ultimately what people do, and look, people are emotional beings, but we justify with logic. And the reason why people procrastinate and never get into the market, they always wait for the right time to be in the market, is because they're waiting for that magic property or that magic window of opportunity. And that window of opportunity will never come, and that magic property doesn't exist. What's actually happening is the psychology, their fear factor is stopping them from entering the property market. So unless you address your paradigms and you have a paradigm shift, you're never going to invest in property, and you're just going to watch the market do its thing over the next 10 years. And I've met many very smart, successful people that have still never invested in property, and I met them 10 years ago, and today they still have no investment properties behind them. And it's got nothing to do with money or serviceability or how smart they are or how successful they are in their business. It has to do with their mindset and psychology. This is 80% of the success formula. Number two, you've got to develop the right plan and have the right system. Without a system, there is nothing. There's just random acquisitions. Plan and system is very important. Developing a team of experts around you is also crucial, because ultimately once you have the psychology and once you develop a plan that's right for you, you've got to have the right team around you who'll be able to actually implement that plan. So I'm talking about a mortgage broker here, your solicitor, your accountant, especially those three people. They are crucial in your life and in your success as a property investor. Without them, there is nothing. If you have a conservative, old school accountant that's anti-property, or an old school financial planner, you're not going to invest in property, because they'll be talking you out of it every time they have an opportunity. So having the right team of experts around you is key. The final thing is understanding property selection methodology, which is exactly what this webinar is all about. How to identify the best performing properties, and how to identify not only the areas but the properties themselves within those areas, and how to make sure you're not overpaying for those properties, and how to secure them correctly. So really, when you look at the whole genre or the whole space of property investing, these four components have to synchronize and overlap. And if one of them is out of sync, the whole thing doesn't work. So let me give you an example. If you haven't got the right psychology, no matter how good your plan is, and no matter how good your experts are, and no matter how good your property selection methodology criteria is, you're never going to get into the market, because there's always going to be something holding you back. And on a subconscious level, what's happening is that your paradigms are not congruent with your plans. And when your body's not congruent with something, it just doesn't do anything, you know, or rejects the notion. If you've got the right psychology, let's say you've done 100 hours of Tony Robbins and you believe you can do anything and walk through walls and walk on fire and fly, which is fantastic, and you've got no plan, but you've got the right experts and the right property selection methodology, you're still going to get some level of success, but you won't know exactly what you're doing and what you're striving towards. So you're going to be randomly acquiring properties without any kind of plan in mind and not knowing why you're actually doing what you're doing. And there's many people like that out there. You know, I meet people with 3 properties, and I asked them, why did you stop at 3? We don't know. We thought 3 was a good number. Okay. Well, why did you buy those properties? We thought the suburbs were quite good, and we know the area. Okay, that sounds interesting. So nothing wrong with that. And, you know, I'll show you the stats at the end and where everyone ends up in Australia in terms of their property portfolios. That's the reality. If you get the right psychology, the right plan, but you have completely useless mortgage brokers, accountants, and financial planners around you, which is the majority of the public, they're going to talk you out of your plan, and they're going to put doubts in your mind and tell you why what you're doing is risky, why the market's going to crash, why Europe's going to crash, why EU is going to crash, Russia is going to prepare third world war onto the whole world, and you should not invest in property right now. You should go conservative and keep your money diversified into bonds and cash and gold and silver. God knows what they're recommending these days. And that's the reality. Without experts, there is nothing. Without the team, you cannot succeed in property investing. Now, let's say you've got the psychology, you've got the plan, you've got the experts, but you don't know anything about property selection. You start buying properties in Point Cook, South Morang and Docklands and South Bank, you're not going to get any growth. So the reality is, it doesn't matter how good your psychology is, okay, I'm going to conquer the world, best plan, best experts, properties don't work. Nothing happens at the end. A lot of action, very little results. The key is, and this is the hardest thing to do, is get all those four things synchronized. And that's what I've been doing through my books and my seminars and my webinars, is teaching people how to get those four things working together and how to get them all working together. And when they work together, it's magic, and that's when success happens. So tonight's webinar is about understanding property selection methodology, which is pretty cool. Here's the reality, by the way, of the entire landscape of landlords in Australia. This is from the ATO and RP data. So if you look at all of investors in Australia that own investment properties, which is about 1.76 million dwellings, 72.8% only own one investment property. So the first thing you've got to understand is majority of property investors in Australia own, which is just under 73%, only one investment property. And reality is they usually buy their property around 1 to 3 kilometres of where they live, to keep an eye out on the property just in case one day they're driving by and it property runs off somewhere. So 18% own two properties exactly. And look, the ATO's got pretty cool stats, because when you're a property investor, you claim depreciation on the property and you do your tax returns. Thereby, this is pretty accurate information. 5.5% have three properties, 2% have four, 0.8% have five, and 0.9%, less than 1%, have more than six. So what I've been interested in doing for the last 15 years is studying those people that have more than six. And a lot of my clients and a lot of my friends have more than 15, 20 properties, some up to 40 investment properties, which is quite incredible. And when you think about, 30 properties or 15 properties, for most people that haven't got one or two, it's like a journey to Mars. It's science fiction, But I spent my whole career working in banking and mortgage broking and real estate just to find these people and find out what they do, how they're structured, which experts they use. And my accountant, my lawyer, my financial planner, all my experts that I use personally to build my wealth have come through those people that I've met at different times of my life over the last 15 years. And all of them are successful property investors with very large property portfolios. So one of the key fundamental things about becoming successful in property investing is this simple, which is what Tony Robbins teaches, is find someone that has achieved exactly what you want to achieve and just copy them without even questioning anything. Because if they've had success, if it's possible for them, it's possible for you. It's literally as simple as that. Ironically, if you think about the school system teaches you, don't cheat, don't look at the other person, do your own thing, which is the worst thing you can do in property investing. Why would you want to make your own mistakes where those mistakes have already been made by other people? It's crazy. So do the opposite of the school system. Find someone that's successful with 10 properties or 5 and just copy and do exactly what they do. Because if it's possible for them, it's possible for you. It's that simple. So why do so few people succeed in real estate investing? Well, most people have a buy, hold and pray investment strategy. There is no strategy. They just buy randomly, usually because the media just talks about it all the time, and you think, well, you've got a fear of missing out almost. I've got to get in because all my friends are buying property and it's the cool thing to do, and I think I've got to buy something, and they get this kind of itch and they just buy something. There's no planning there, there's no methodology, there's virtually nothing. And there's nothing wrong with that. I mean, at the end of the day, not everyone wants to become a successful property investor. Some people are just happy working all their life and just having 1 or 2 properties on the side, and that's cool. That's not what this webinar is about. This is about finding the best performing properties. There's a bunch of other reasons which I won't go into tonight. Obviously, psychology is a big one. Conditioning through parents, your peer group, etc., etc. Warren Buffett says, "Be fearful when others are greedy. Be greedy when others are fearful." It's one of my favorite quotes of all time. Let's go back in time and talk about the history of the Australian property market. Before I give you a bit of a summary of what's happening now in the property market, I want to go back in history and just show you a little bit about what happened in Australia in the property market. And this is the median prices of the Australian property market since 1890. And you can see there, look, the market wasn't doing much from 1890 to about mid-40s after the Second World War. And after the Second World War, something very interesting happened in Australia. The market started going crazy. What happened in the 50s? Well, in the 50s, we had the influx of European migrants into the country. We had all the Greeks and Italians and Polish people come over on the boats. And when they landed, the first thing they did was learn the language, get a job, work their asses off, and buy property. And you know what? They've never stopped. If you look at some of the best suburbs in Melbourne and Sydney, some of the best suburbs are actually owned by Italians and Greeks that moved here in the 50s and 60s. So there was a number of booms past that. But really what happened is population growth to a large extent at the right time creates pressure on property prices. But I can tell you now, population growth by itself doesn't create consistent capital growth. And I'll talk about that myth in itself later on, and I'll show you the stats to back that up. This is some media article quotes plotted against the Sydney median house prices. And mainly I talk about Sydney because it's the most important and biggest property market in Australia. But there's a notion, that the property bubble is eventually going to burst. It's been bursting now for 10 years, but nothing's really happened. Every year we see a bunch of so-called experts come over from the US saying that our property market's overpriced, it's going to crash, and they're going to make millions out of betting the other way. And every year they go back to the States, broke, and the market continues to go up. And we'll talk about why that is today, and what are some of the key factors that make our market very unique and very different from the US market. In September 93, for example, these are headlines, by the way, from major newspapers. Sydney wins the Olympics, property prices unlikely to rise. In 99, interest rates rise concern. Experts predict 20% drop in property prices. February 2002, has the property bubble burst? Possibly wrong time to invest, good time to sell. September 2002, property bubble about to burst. January 2003, is there a bubble? September 2003, property bubble will damage the economy. Well, this is the Sydney property market since 1901. And that little bump in the road that you saw, that's this part here on top. There's always going to be people telling you it's the wrong time to buy property. Because, academics are very interesting individuals. Usually they end up broke. There's no such thing as a retired multi-millionaire professor from Monash University. They end up broke, dead broke at 65, 75, somewhere alone, in a cubicle somewhere. I'm just kidding. There are no retired millionaire professors. Academics think it's always really cool to be very negative about the future. No matter what the market's doing, no matter if it's good or bad, it's very bad for an academic to say, you know what, I think the market's really good right now. I should be buying some investment properties. That's not a good thing for them to say. What they want to say is no matter how well the market's doing, is they want to be pessimistic, be conservative, be cautious. That's the accepted reaction to a good market. So if the market's doing 12%, like it was last year, academics will come out and say, well, it's doing 12%, but be cautious because next year we expect a downturn and blah, blah, blah. It's always a downturn. There's always an expected negative front coming up ahead. And the reality is if you look at those guys and you look at their property portfolios, they have no assets behind them. So number one key thing is if you're getting advice from anyone, forget about the letters after their name. Look at the numbers in the bank account. I only take advice from people that have the results that I want. So I don't care if you got to, I've got diplomas. My diplomas are worth nothing. I did a business degree at Monash University, wasted 4 years of my life playing pool in the tavern, drinking beer and doing assignments with people I freaking hate. That's my 4-year degree at Monash. Nearly did an MBA, more bad advice from people that are broke. My lecturers are on 80 grand a year. What the hell can they teach me about investing? It's insanity, So if you want to learn about money, learn from people that have actually made money, not from people that are teaching people how to make money. That's the key distinction. So beyond all my degrees, the biggest thing about me is that I'm actually a property investor that's in the market every day buying properties and selling properties and making money. And that's the most important thing that I can just, impress upon you in this whole thing. If you look at the median prices in Melbourne, in 1966, the median price for a detached house was $13,000. In 76, $37,000. In 86, $83,000. In 96, 144. In 2008, 432. Currently, it's around 600, 650. Now, one thing is, number one is Melbourne property prices have always been extremely expensive and unaffordable. Melbourne has never been affordable, full stop. It's always been beyond the reach of every person. Number one, you've got to understand that as a ratio of household income per year. Number two, no one in 1966 would have believed that their properties would triple over the next 10 years. People don't believe they're going to triple, but they triple. You know, no one believes that properties will double again. In 96, if you said to everyone, did you know your house for 144 grand in Moorabbin is going to go to 400 grand in 2008? No one would believe you. It's impossible because they think themselves, well, we can't afford our mortgage currently. How can they go to 400,000? Who's going to be buying them? It's almost, you know, it's insanity. No one believes today that the average property median price in Melbourne will go from 650 to 1.3 million in 10 years' time, but it will go there. It has gone there before, and it's actually speeding up. And it's going to go there with or without you. It doesn't need any more money to do it. The money's already in the market. The real estate market in Australia is currently worth $6.5 trillion. It doesn't need any more money for it to continue to go up. The money's already being created inside the market. And that's the key thing that people always miss. The other key thing is that when people assume that affordability is a big factor, don't forget that the leverage, the equity position in the Australian property market is very high. You know, we've only got about $2 trillion worth of debt against $6.5 trillion worth of assets. A lot of houses in the best suburbs are completely paid off. There is no mortgage against them. So when people think, well, we can't go to 1.3 billion because who's going to get their mortgage? Well, the guy that's already got a house paid off for 800 grand will get that mortgage. That's the reality. So the thing is, these suburbs can go from 1 million to 2 million, from 2 to 4, because there's already people in the surrounding suburbs that want to live in that suburb. And that's the key thing. People always think, well, that every time you're getting a property, you're going to have to get a mortgage for 100% or 80% LVR or 90% LVR against that property. That's not true. If you look at the Sydney property market, there are dozens and dozens of suburbs now with a median price over $5 million. And you think, who can afford a $5 million house? The guy that's got a $4.5 million house paid off. That's who. And that's the reality. These are not first home buyers. And that's one of the hardest things for people to understand. If you're not in the industry, like myself, I'm in finance and real estate, so I know the figures. You know, this is an article from 1970, and it talks about how red herrings are dragged up, but most cases, the only reason that stops them is their own will. When most people marry, it talks about why people cannot get into the property market and how they just have to start saving money, and everyone's priced out of the property market, which is interesting. And this is 1970. I mean, you had the same issues, the same stuff happening then as there is today. In my book, Australian Property Finance Made Simple, I actually got data from RAIV, and this is the median price in Melbourne from 1966, and you also have a corresponding auction clearance rate and annual capital growth against the median price. So you can have a look at the doubling effect. The reality is the Melbourne property prices, detached home prices, have doubled every 7 to 10 years as an average since 1966, which is really where we've been capturing data accurately. Does it happen every year? No, absolutely not. Look at the sporadic growth of some of the years. Some years it's negative and then suddenly goes up by 20%. Some years it just goes sideways. And remember, this is all suburbs captured together. I mean, Melbourne has 316 suburbs. You know, not every suburb is going to do well in the next 10 years, but I'm saying as a median price average, that will happen. What you want to do is cut through all those suburbs and narrow it down to only the suburbs that are worth investing in. And out of the 316 suburbs in Melbourne, there are only 45 suburbs that I have identified that are worth investing in. The rest are not worth investing in. This is from 1997, from the first edition of the Australian Property Investor magazine, and it gives you the top 10 most expensive suburbs in Melbourne. You got Toorak at 850,000, Brighton at these are detached houses, by the way. Brighton 501, Melbourne 440,000, Armidale 407,500, Kew, the poor bastards, 385,000. I mean, you can't get a one bedder in Kew for 385,000. Campbell 370,500. Melbourne East 356, 250. South Yarra 350. Glen Iris 330,000. And Baldwin, all those poor people, bottom of the list in Baldwin, struggling there in those Victorian mansions, 325,500. Most affordable, or another word for the cheapest, Melton, 87,000. Noble Park, 96,500. Sunshine, 100,000. Glenroy, 102,000. St Albans, 103,000. Sunbury, Dandenong, Frankston. Now, if I were to print off, and I'll show you in a second, the most expensive suburbs in Melbourne today, guess which ones they are? Same suburbs. If I gave you a list, and I will give you that list today, and I'll show you the latest stats, of the most affordable, the cheapest suburbs in Melbourne, guess which ones they are? Nothing's really changed. Now, nothing's really changed in Melbourne. There's a perception that things have changed, but really there's nothing that's changed. And this is one of the key distinctions that I've picked up over the years, being obsessed with one particular industry. And it's really a key distinction that allows you to gauge how much knowledge you have derived from an industry. If you're currently looking at the property market and your perception is that there is a massive amount of change happening with finance, with the new consumer credit code coming in, with APRA forcing banks to tighten credit policies, with the landscape of all the different suburbs changing, if your perception is there is a lot of change and you don't know what to do, that means your level of awareness is very low in property and finance. And that's a good starting point, because that means you're taking responsibility for your knowledge base, and then the next thing is to work out, what do I need to do to gain more awareness, and which is more education and more knowledge, so I can get really comfortable with the property market. The reality is, guys, after 20 years of investing, after 20 years of being in banking and finance and real estate, nothing new has happened over the last 10 years. There's nothing new. It's same Groundhog Day over and over and over. It's boring and predictable. But there's a whole new generation coming into the market every year with the perception there's new stuff happening and it's all confusing, and who do we talk to, and people have different opinions. Everyone's got an opinion, but the issue is that most people are unqualified to give an opinion. And that's the reality. And the biggest people that are unqualified to give opinions about the property market are real estate agents themselves, who are not investors, economists, and so-called experts in the industry. The only people that are qualified to give advice are property investors with more than 15 properties, in my books. And that took a long time for me to understand, because starting out 20 years ago, I was always impressed with people that had diplomas and degrees behind them. Like myself, I've been through the system, and when I come out the other end, I realized they don't know anything. It's scary. Mortgage brokers don't know anything. Real estate agents know stuff all about stuff all. But you have to be a real estate agent for 10 years to work that out. That's the reality. So what's happening in the Melbourne property market right now? This is as of ending week 10th of July 2016. You can have a look at the median prices. And look, the median price fluctuates every single week, because it's just a comparison of the middle property sold in one market versus the middle property sold in another market. So in Melbourne, for example, in 1 week there was 2,921 homes sold, and the middle property was worth 600,000. Median price movements are the worst way of measuring the market. It's really what I call nonsense statistics. It's probably the most meaningless thing you can, well, it's got no application or purpose at all as an investor. I don't even look at median prices. They just mean absolutely zero. But the whole industry is obsessed with reporting this median price movement, saying, Melbourne did 11.3 and Sydney did 12.1, and this is what's happening and this is why it's happening. It's got no correlation between anything. Remember, Melbourne is 316 suburbs. In that 2,921 sales that week, we had St Albans and Toorak. We had a mansion for $6 million, we had a property for $380,000. It's got nothing to do with each other. So the first thing I want to teach you guys is what not to focus on and eliminate. There's a lot of white noise in the industry. You just got to eliminate it. And you got to focus on stuff that really matters. When you look at the actual, and this is the capital city home value changes, this is the actual fluctuation of capital growth. You've got Melbourne 8.9, Sydney 9.9. It really doesn't mean anything either. It gives you an overall sense of direction as a general rule of thumb, but it doesn't really add value to you as an investor, because you can't invest in the Melbourne index. You can only invest in a property in Melbourne. And even within a suburb, there are good properties and there are bad properties, and there are even locations of properties make a difference in capital growth. You might have a property on the main road next to power lines that will underperform compared to a property opposite a park in the best street in the suburb. So getting all these suburbs together and clustering them together and deriving some kind of a common statistic out of them and then comparing a statistic over a period of time, it's nonsense statistics. It doesn't have any application as an investor at all. It's got nothing. Now, here's where we're getting to some cool stuff that actually makes a difference. Okay, volume of listings. Volume of listings is the number of properties that are actually getting listed in the market every week. Now remember that 70% of the market is made up of owner-occupiers, and consumer sentiment has to be positive for them to list properties and sell properties. So volume of listings gives you an understanding of how good the market is. And this is one statistic that I really look for. So I'll look at a number of statistics. I'll show you how I read the market. So if you look at Melbourne, for example, this is, in that particular week, there was 6,397 homes on the market, which is 16.6% less than the previous year. Which is interesting. So new listings 6,397, and it's going backwards. So what's happening in Melbourne is the volume of listings or properties that are coming onto the market is dropping, which is interesting. So people are holding back for two reasons. They don't think they're going to get a good price for their house, and they can't afford the next suburb. They can't afford to upgrade. And that's why the average time an Australian is holding onto their home has increased now from 7.2 years up to 9.8 years. So people are just holding their houses for longer, building up equity, mainly because they can't afford to buy the next home. They can't afford to upgrade to where they want to be, or they believe it's the wrong time in the market to actually upgrade. The other thing I look for is the amount of days it takes for a property to sell, and vendor discounting, how much discounting vendors have given to get the property sold. Apart from auction clearance rates, which is a really good indicator, vendor discounting and time. So for example, in Sydney, for example, right now, it takes 33 days to sell a house. In Melbourne, it's 32 days. Units, it's 36 days and 31 days. And then you compare this time, same time last year, and what you're going to find is that it's taking a little bit longer to sell properties, and our auction clearance rates are dropping, as well as the volume of listings are dropping. So we are slowing down as a market, in terms of Melbourne. So median time on the market, you can see there, number of days for different areas. You've got Melbourne there in Sydney, and you can see, Perth and Hobart, for example, and Darwin are at the bottom of the property cycle, where Melbourne and Sydney are at the peak of the market. 30 days to sell a house is super quick. You literally get a contract of sale. I think 30 is like the lowest you can ask for. I mean, who's going to settle anything in 25 days? From a banking perspective, it's not even practical to do a contract of sale less than 30 days. Even if you're a cash buyer, just allow the solicitor to transact. It's one of these things. Average vendor discounting is also a really good indicator. You can see that Darwin, people are just desperate in the discounting units especially. And houses have discounted by an average of 9-10%. 5% discounts are nothing special. It just simply means the properties were passed at auction and people giving a slight discount to get the property sold. So these indicators that actually mean something. It means it tells you what the consumers are doing in the market, whether they're selling their houses, how quickly are they selling their houses, and how much discount are they accepting to move those properties. So that's actually quite interesting. Apart from the average is obviously comparing one period of time to another in terms of the listing index. By the way, if you look at the chart on the right hand side, you can see there's a massive dip in December and January. That's because agents don't work in January and December, and they don't want to do any sales, and because mainly no one wants to buy properties around Christmas time. So really, if you look at the property market, you can see that the market only operates 10 months of the year, and that's the reality, of the property market. Auction clearance rates are very important, and in Melbourne especially, there are 8 distinctive markets with very different auction clearance rates. So once again, if you look at the Melbourne property market as a general market, which is not a good way of looking at Melbourne at all, you had an auction clearance rate of 71.9% last week. Auctions, there were 603 houses sold. and then you have cleared auctions, uncleared auctions, and you got the total. The cool thing is that you look at last year in Melbourne, the auction clearance rate for the same week was 77.4%, and we had 655 homes sold that week at auction. So what's happening is, auction clearance rate simply means that 77.4% of homes that were auctioned that weekend sold. So 7.7 out of 10 homes were sold. So you can see that auction clearance rates are going down, which means the market's slowing down, which means buyers are not accepting vendors' prices, and vendors are slowly increasing discounts to get the property sold. That's what's happening in the market. At the same time, the reasons listings are becoming lower is because not everyone needs to sell their property. Some people need to sell properties because they've made other commitments, they've changed their life, they're moving into a different area, a different state, overseas, divorce, etc. But there's a good percentage of the market they choose to sell if they want to, only with the notion of upgrading. And they're the ones that are pulling out of the market right now. The best suburbs in Melbourne have no listings. People are holding back. They wanted to see what's going to happen with the election. They want to see what happens with Britain exiting EU. They want to see what happens with Donald Trump will get into presidency in America. A lot of uncertainty. When there's uncertainty in the market, people pull back and they're going back into the comfort zone. So we can see that which clearance rates are very important in terms of gauging where we are in the property market. At the really true boom period, which is the last property boom was 2001, 2004, auction clearance rates got up to 96%, which means every property was virtually sold. We haven't had a boom since. People claim those booms. There really hasn't been, because the listings just was simply not there, and the auction clearance rates never got up that high. They never clocked the 90% mark. And that's the reality of the property market. If you look at Melbourne sub-regions, Melbourne is now divided into specific areas which have nothing to do with each other. For example, Toorak and St Albans, nothing to do with each other. Still part of Melbourne. You can't put them together anymore because it just doesn't make sense. So you've got your inner market, 72.3% auction clearance rate. You've got your inner east, inner south, northeast, northwest, outer east, southeast, west, and the Mornington Peninsula. And you can see that in one particular week, you have a variety of auction clearance rates, from 83.3% in northwest down to as low as 58.1% in Mornington Peninsula, which is apparently now part of Melbourne, sub-regions, which is interesting. So where are we currently in the property cycle? Well, the property cycle is more an art than a science. And I'll show you where you can get really accurate information about this. But really what it is, you've got the peak of the market, which is very short and sweet. And you're either going to have properties before the peak, or you're going to end up just watching the whole market go crazy, trying to get in. Trying to get in at the peak is silly because you're overpaying for properties. Then you're going to experience a decline of the property market. And I'm talking about medium price decline. Not every property goes down in value. Some suburbs actually boom and continue to boom, and they've done exceedingly well. In Melbourne, I'll show you those suburbs. They've never had a decline. Then you've got the bottom of the property market, and then you've got the growth of the property market. Now, if you want to break that down even further, there are specific triggers in the economy, and this is in my book, Australian Property Finance Made Simple, where you have different indicators triggering the next stage of the property cycle. So where we are currently is construction increasing. We're about 11 o'clock on the property clock, in my opinion, but some experts claim we are already at 12. When we are at 12, we're going to have rapidly rising prices. We haven't seen that yet. Then eventually, because prices go up so much, you have falling yields, which has happened. Melbourne rental yields on houses are down up to 3.2%, and for units 3.7%, because there's an inverse relationship between capital growth and rental yields. So capital growth shoots up, rents are usually fixed for 12 months at a time. They don't go up every week or every month. You can review your rentals at the end and increase them depending on what your property manager will tell you. But at the moment, rental yields are record low in Melbourne. Eventually, there's going to be oversupply of properties in the property market in some suburbs of some properties, not every suburb. I'll show you which ones. And then we have a potentially historically increasing interest rates, which we might experience. I mean, we've got record low interest rates in Australia, bank swap rate 2.5%. We've got interest rates in Europe and Japan, which is zero. Then we've got lower property sales, construction decreasing, property prices falling, and eventually rents catch up around 6, 7 o'clock. It takes them a number of years to catch up to the capital growth of properties. Suddenly you have cash flow positive properties. Suddenly people start saying things like, why would you know, rent money is dead money, well, it's cheaper to own than rent. More people enter the market. There's an undersupply of rental properties, falling interest rates, rising property sales volume, construction increasing, and it goes around again. The experts that I listen to are Heron Todd White Valuers. That's the website there, htw.com.au. They're the biggest valuation company in Australia, and they are the experts, and they're the ones that come up with the property clock, you know, pretty much every month. So Melbourne is now, according to them, at the peak of the market, which could be right, and we could be there for a number of years. I personally think we're about 11 o'clock. They think we're about 12 o'clock. So we're definitely up there. You know, where we are, time will tell. And one of the challenges is reading stats is that you're always looking back 6 months before we get really accurate stats. By the time all the agents like myself give all the sales to RP data and it gets recorded and the State Revenue Office comes back with their data, that could be 3 months. So we're always looking back at the market to identify truly where we are. It's very difficult at this point in time to know exactly where we are. I've got a gut feeling about the areas that I focus on. I'll show you what I think is happening, but definitely I don't know every market in Melbourne. I know Melbourne extremely well, but not every suburb, because every suburb has its own distinctive market as well. But anyway, that's where we are at the property clock. So is it a good time to buy property right now? You know, some people say, it's overpriced now, you're paying a premium. Well, yes and no. I think the best time to buy property is yesterday, always. You know, it doesn't really make a difference if you overpay for property. You know, remember the median price 10 years ago in Melbourne was 230 grand. If you pay 240, would it make a difference to you today? Probably not. You know, so my advice to people is just to buy as much as you can, given your specific plan of attack. You know, don't worry about what people are saying. Stick to your plan, develop your system, get your experts, create methodology, and just implement it. And when the property market goes up and you've got a bunch of properties, you're just going to look really smart. And that's the reality of the situation. I think Melbourne's around here. I don't think it's peaked. I think depending on, and there's so many variables, but I think Melbourne will peak next year. And I think, and then the year after there'll be a slowdown in the property market, medium price only. That's what I'm talking about. Which areas to target in Melbourne? Melbourne's a very interesting city because it has the biggest urban sprawl of any city in the world, which is interesting. And because of the urban sprawl, Melbourne is just growing in every direction. There's a lot of challenges that have occurred, mainly with infrastructure, schools and transport. And Melbourne has these 4 so-called growth corridors as well. We have the Western Growth Corridor, we have the Sunbury Diggers Rest Growth Corridor, we have the Northern Growth Corridor and the Southeast Growth Corridor. It's funny because as a real estate agent, I get phone calls often from land developers and builders saying, we've got properties in the Northern Growth Corridor. I said, what exactly, which suburb? We have properties in, you know, Roxburgh Park or South Morang. I said, well, first of all, don't call it a growth corridor because there is no growth and there is no corridor. So why would you call something a growth corridor where there is no growth and there's no corridor? So it's going back to Melbourne. You can see the urban growth boundaries, which were fixed in place by the government, stopping Melbourne from sprawling out infinitely. And the main reason they did that is because when this was happening, they studied 2 cities that took a different approach. City number 1 was Los Angeles, which allowed infinite urban sprawl in every direction. And Los Angeles eventually ended up with a lot of slum areas where there's 5th generation unemployed living in an area, and a lot of social challenges in those areas as well. And then they went to London, and London, what they decided to do is lock the urban growth boundaries and restrict rezoning beyond those boundaries. So beyond that line that you see there, the little green line, all that land will be farmland, and that's never going to be rezoned into residential property. The dark grey areas represent about 25 years to 30 years worth of land that's already been rezoned residential or about to get rezoned residential, and this is where majority of housing will be built in Melbourne. They are the worst areas to invest in, and I'll talk about why. So this is how Melbourne's very unique as a city, in terms of what is actually happening with Melbourne. And as an investor, you've got to be aware of this stuff. So should I invest in house and land estates around Melbourne? Well, the biggest thing about house and land estates, especially for migrants and especially for first-time investors, is that for $450, 450,000, I should say, you get a lot of bang for your buck. You know, you get a 400, 500 square meter block. You know, you can get an entry-level metrical on A.B. Jennings home with 4 bedrooms, 2 living areas, and double lock-up garage. You know, in terms of value for money, there's a feeling and a sense of value for money. But I'm going to show you what the growth in those areas is in a second. I'm going to show you specific properties and why this is the worst thing you can invest in as an investor. Now, as an agent, I have access to 96 house and land estates in Melbourne right now. So I've got infinite access to this stock. Okay, so it's not like I haven't got access to this stock. I'm just bagging it because I can't give you a property in Point Cook or Pakenham. I can give you Point Cook and Pakenham all day long. The reality is you're never going to get any capital growth there, and I'll talk about why, and I'll show you the stats to back that up. So what's the historical performance of house and land estates in Melbourne? And the reality is, and this is the challenge that you have with these suburbs, which brings us to the number one factor that creates capital growth, which is scarcity of stock. If you look at areas like Point Cook, and you can jump on realestate.com right now, or after the webinar, I recommend, because you're going to miss out all the information. Type in Point Cook, look at how many houses are up on the market. 532 when I was looking at realestate.com a few weeks ago. Truganina, 465, Tarneet, 503, Craigieburn, 336, Mernda, 359, Pakenham, 574, Berwick, 346. Now, in Pakenham, out of those 574, I guarantee you that about 500 of them will be very similar in size and land. So you've got virtually identical product on the market. You almost got a commodity. It's not even property. It's almost a commodity because you've got a 4x2 over and over and over being sold. Now, if you look at the best suburbs in Melbourne, Albert Park, 16 houses, West Melbourne 5, North Melbourne 13, East Melbourne 4. I bet you out of East Melbourne, those 4 properties, they're completely different. One could be a Victorian, one could be a double-story Italianate mansion, one could be a 1960s property, you know, one could be whatever, postmodern, you know. So they're not really competing with each other. You know, apart from the location and all that proximity to the city and infrastructure, we're talking about just scarcity here. The challenge with the fringe suburbs in Melbourne is that there is infinite supply always coming onto the market. In fact, there is no secondary market demand for those properties. It's predominantly a first home buyer's market because of stamp duty savings. Why would you buy a 3-year Point Cook Metricon home? We can go to Metricon, get the same house, design it the way you want it, and not pay any stamp duty, or virtually pay, you know, $5,000 stamp duty instead of $30,000 stamp duty. So there is no secondary market for fringe suburb house and land properties. So which areas of the suburbs represent the worst investment opportunities in Melbourne? Well, I'll show you which ones I believe represent the worst opportunities, and then I'll show you the capital growth over the last 10 years of those suburbs as well. Now, by the way, when I talk about investing, I'm not talking about living in those areas. They've got nothing to do with lifestyle. Most of these areas actually very well located for families. They're cheap, they're cool, no problem with living there, just don't invest there. And I say that because every time you invest $1, you've got to ask yourself, what's the opportunity cost of holding money in that area versus another area? And that's all it comes down to. There is no emotion when it comes to investing. Being emotionally attached, it's like saying, I don't want to buy BHP shares because I don't put petrol at BHP, or I don't want to buy Woolworths shares because I shop at Coles. It's got nothing to do with it. It doesn't matter where you live. That's an emotional decision, but where you invest should be purely based on numbers and stats. Okay, the glut of properties in 2012, which was peak pretty much, were in these areas: Hoppers Crossing, Tarney, Truganina. There was 4,448 homes on the market. Just think about that for a second. 4,000 homes for sale in the area. I mean, if you look at St Kilda houses, that could take decades. You wouldn't even hit 4,000 homes. You know, Cranbourne, north, south, east, west. Sandhurst Sky, 3,931. Doreen Mernda, 3,718. Derrimut, Point Cook, Werribee, 2,961. Pakenham, Pakenham South. Melton, Melton West. Roxborough Park, Craigieburn, Clyde, you know. So you can see there, there's a huge amount of glut, and that the glut of stock creates low capital growth because you're creating a situation where there's virtually infinite supply. Those areas, by the way, those suburbs are located in dark grey for so-called growth corridors in Melbourne. If you look at the Melbourne suburbs that have deemed to be at high risk unemployment, this shows you the red suburbs. Now think about what's happening in Melbourne. Well, let's step back for a second and talk about Australia. We've got a population of 24 million. The biggest contributor to the Australian economy is the financial services and banking sector. That's the number one contributor of employment and GDP. The second one is export of commodities. So there's two drivers in Australia. And when you look at Melbourne, what's been happening to manufacturing in Melbourne? Ford, Toyota, everyone exiting the industry. What's happening to Geelong? You know, everything's shutting down. So what you have is you've got a concentration of blue-collar workers in these areas that are losing their jobs. If there's a high risk of unemployment in those areas, what's going to happen to their homes? They're going to be back on the market. And if there's an infinite supply of the same home, what's going to happen to the prices? They go down. If you look at the low-risk suburbs, most of the suburbs are made up of white-collar workers. So one of the key distinctions when it comes to investing, I'm not talking about living, you could be a blue-collar worker working in a factory, but you should never invest in the suburb if the suburb is predominantly made up of blue-collar workers. You should be investing in areas where there is predominantly white-collar workers. I mean, sometimes I think I sound harsh when I'm saying this, but this is just pure investing. It's got nothing to do with where you live, what you do for work. That's irrelevant. Investing is about maximizing your chance of making a return. That's it. There's nothing else to talk about. If you look at, for example, the biggest areas with crime, once again, the red areas. If you overlay those areas with the growth corridors, there you have the areas with the biggest challenges with crime, gangs, homicide rates, etc. This is Victoria's worst struggling towns revealed from a Dropping Off the Edge report, which is a government report that you can actually download and have a read over. And it talks about the most disadvantaged areas in Melbourne economically, called the struggle towns. By the way, this is a government report. Government reports are really cool to read because they're fairly unbiased as long as the information was gathered correctly. If you look at the biggest offenders, you got Broadmeadows, Corio, Doveton, Frankston North. You know, it just goes on. You know, it's the same suburbs over and over. I'll show you the growth of these areas, by the way. Just even listening to the news, it's always a man was shot last night in St Albans. You know, it's always the same. A man was stabbed last night in Broadmeadows. You know, it's never a man was stabbed in Toorak. You know, that's the reality of Melbourne, the makeup. So what happens if you get it wrong? Let me show you now a specific example of properties that were valued by an independent valuer at 2 different times, because that's a really accurate way of working at capital growth. And then I'm going to show you the capital growth of these areas over the last 10 years. And I'm going to show you the growth of the best areas in the last 10 years. And then we're going to talk about the best properties to target in those areas. So in this area, here's a 1960s 2-bedroom flat in Elwood, in Tennyson Street, Elwood, which is the street that I grew up in, which was just an average street back then. The flat sold for $632 in May 2011, having previously sold for $475 2008, equating to annual growth of 10%. Nothing special, guys, just a red brick, boring flat. One of the worst areas you can invest in Melbourne is Docklands, and this is a flat or an apartment that was purchased in Docklands, which sold for $540 in 2010, previously purchased for $495 in 2005, capital growth 2%. This is another property that was an Edwardian 2-story home, sold for $780, having previously been sold for $270 in 98. Annual capital growth 10.12%. This is a 3-bedroom house in Derrimut that was bought for $330 in 2004, and then sold. Sorry, it was previously purchased, for $330 in 2004, sold for $335 in 2012. Capital growth of 0.2% over 8 years. Now think about this. This could be a nice home for your family. It could be cheap and conveniently located to the city. Nothing wrong with it. But if you guys want to build a large property portfolio, you're going to struggle if you're getting capital growth of 0.2% per year. It's going to take you 90 years to buy your 10 properties. Here's a 1-bedroom flat in Rowena Parade in Richmond Hill, overlooking the MCG. Nothing special, right? Not a postcard property, boring, nothing really special to look at. Sold for 468,500 last year, previously sold for 79,598, equating to annual growth of 15%. Now, the growth suburbs all have something in common, which I'll share with you towards the end of this webinar, and I'll give you the winning formula. Another one in Docklands, and this is in Burke Street, which is the nicer part of Docklands, sold for 422 in 2010, previously sold for 410 in 2007. Capital growth 0.25% per year. Now, if you want to lose money, you don't have to go to Docklands or South Bank. You're better off just going to the Gold Coast, because at least you can be depressed on a nice beach and claim it as a tax deduction, because you can actually travel to investment property interstate and spend up to 3 days there. This is a pinnacle representation of how bad the Gold Coast property market is. And I guess the biggest property, the tallest building in the Gold Coast is the Q1. And recently there was a 3-bedroom property sold in Q1. The asking price was $890,000, and it's 205 square meters, which is a beautiful property. Last traded for $1,050,000 in 2002. Initially, it listed in 2011 for $1.2 million asking price. I mean, the capital growth, and now it's on the market for $890,000. The market is zero. It's negative. Don't worry about inflation. You're just losing money. Why? Because Gold Coast has infinite supply and it's got no fundamentals. It's hospitality and tourism, but there's infinite supply of stock. That's the reality. So what are the best areas to target invest in Melbourne? These are the national Australian top 20 suburbs across all major capital cities. And you can see, look at Melbourne. Look at the second column there. I mean, it's Melbourne virtually dominating the whole market. And Sydney's only got a few in terms of capital growth. Sydney has more expensive suburbs, but hasn't got high growth suburbs. Melbourne is the best property market to invest in Australia, full stop, in terms of growth potential. Mount Albert, Melbourne, 11.8%. You've got Balwood North, 11.4%. That's average capital growth over 10 years from domain on detached houses. Middle Park, 11.1. Mount Albert North, 10.6. Ashburton, Balwyn, Glenwaverley, Doncaster, Burwood, Mount Waverley, St Kilda West, Box Hill South, all 10% plus suburbs. And then you go down the list, to high nines. And remember, just because Camberwell's 9.8, there are properties in Camberwell that have done 11%, because that's the average of the suburb. If you look at and this is the Melbourne's top 20 suburbs to invest in with the highest capital growth of the last 10 years. Mount Albert, 11.8, and it goes down Balwyn North, Middle Park, Mount Albert North, Ashburton, Balwyn, Glenwaverley, Doncaster, Mount Waverley, St Kilda West, Box Hill South, Dippendi, Camberwell, Blackbird, Surrey Hills. They've all got something in common, which I'll share with you. There's key fundamental things that are common within all those suburbs. Let's look at the worst areas to invest in Melbourne. Brookfield in Melton, annual capital growth of 2.5% on average over the last 10 years. Now remember that inflation is 3.75%. So that house in Melton for $345,000 is actually going backwards every single year. Officer, Red Hill South, Drysdale, Greenvale, Williams Landing, 3.2%. Everyone talks about Williams Landing, how it's magnificent. It's the highest growth area in Melbourne. Wyndham it's the highest population growth, but it's not the highest capital growth area. It's actually going backwards. South Moranga has gone up by 3.3%. Trigonina, 3.3%. Lara, Geelong, you just don't invest anywhere near Geelong because that whole city is gone. I mean, the amount of, it's predominantly blue-collar manufacturing, and as you know, manufacturing is exiting Victoria completely. Now, it's a great area to live in. You can actually buy really nice properties there for a fraction of what you pay in Melbourne, and for lifestyle, fantastic. For capital growth potential, disaster. Point Cook, another Wyndham. Wyndham's one of the fastest growth areas in Melbourne. You see all the articles in the Herald Sun and The Age. Wyndham, and I'll show you the growth on it. Yeah, it's population growth off the charts, but capital growth, it's below inflation, guys. I've got clients, when I used to do mortgage broking, I've had clients buying in Point Cook and getting no growth in 5 years on properties. St Albans, Tarneit. There are commonalities with all these suburbs as well, and then you're gonna get a copy of this as well. If you look at the fastest growth areas in Melbourne, and this is the thing about biggest lies in property investing is this: population growth creates capital growth. No, it doesn't at all. Melton's the fastest growing area in Melbourne. It's got the worst capital growth in Melbourne. That's point in case. Wyndham is second. It's the fastest population growth. It's got the worst capital growth. Why? Because you have infinite supply of stock, and the biggest other thing is you have predominantly blue-collar workers or white-collar entry-level workers with low incomes. So the definition of capital growth is scarcity of stock with a population that lives in the area that has high incomes and they have the ability and willingness to pay above market. The definition of no capital growth is the opposite: infinite supply of stock. I mean, it makes logical sense when you think about it, right? Infinite supply of stock and population that has no ability to pay above market. That's the definition of low capital growth. The most expensive properties in Melbourne, by the way, or suburbs, have done well as well, but most of them are not in the top 20. Toorak, 3.2 million, Middle Park, 2.4, Dippendy is 2.25, Canterbury, 2.2, Malvern, 1.9, Brighton's 1.9, when we go down the list. The other thing is you're going to see commonalities between these suburbs. Now, obviously, you're priced out of the detached housing market for most investors, but you can still buy really good townhouses in those areas and apartments. Interesting thing, if you look at Kew, the value of houses in Kew rose $200,000 every year for the past 25 years. If you just bought a detached house in Kew, think about how crazy that is, and just did nothing to it, you would have made $200,000 on average for the last 25 years, which exceeds the majority of 99% of all income earners in Victoria. So if you look at the Melbourne suburbs, the red dots represent the most expensive and best suburbs in Melbourne and the highest growth areas. The yellow and green dots the cheapest. So there's a couple of common themes coming through about Melbourne. Number one is you got to buy in areas where there's no more stock being created. So you have scarcity of stock. So people are fighting over limited stock and there's no listings. So no one's listing anything. Number two, you got to have areas where there's high income per household, way above national average, where people have the willingness and ability to pay above market. That's the key thing. Then you look at infrastructure, schools, transport, and all the other obvious things. But the biggest thing is location, location, location doesn't determine price, population growth doesn't determine price, and infrastructure spending doesn't determine capital growth and price. Those are all lies. People tell you that when they sell you real estate, new estates. Oh, infrastructure investing $10 billion and population growth off the charts. Third fastest growing town in Australia means nothing. Facts. These are top 10 suburbs that just joined the rich list in last year. And you can see there, it's kind of spilling over into Abbotsford, Heidelberg, Bulleen, Templestowe Lower, Doncaster East, Donvale, Blackburn North, and Vermont South. And it's just going down. So this is the pocket you want to be focusing on for your capital growth. If you look at the income required to purchase the median house in an area for couples with 2 children, the dark blue areas represent the best areas where you need an income per household of $150,000 to $200,000 per year just to buy a house there. So think about who lives there. What do they do for work? Majority of those people in the dark blue areas work in white-collar industries, banking, financial services sector, and they are the least affected and volatile industries and the most profitable industries, and more importantly, they contribute more to the GDP than any other industry. The industries to look out for is manufacturing and blue-collar dominated areas, which is the ones that are going to suffer in the next 10 years. And if you look at the history of Melbourne 2001, 2011, you can see affordability, serious unaffordable dark blue patch in 2011 just keeps growing. So they're the areas that I target as a real estate agent, as an investor, when I source for my clients, are the only areas that I go to. The other thing you look for is the top schools in Melbourne. If you look at the Chinese community, the Russian community, the Indian community, those that can afford to, where do they send their kids? To the best schools in Melbourne. Where are those schools located? They're in the inner east, southeast, and the Bayside. The top best schools in Melbourne are all located in the same suburbs. That's why people go to Baldwin. That's why people go to Glen Waverley. That's why people go to Brighton. That's why people go to McKinnon, to go to McKinnon High. You know, that's worth 25 grand a year you're getting for free, but you got to be in the catchment area. So if you add income, scarcity of stock, and the best schools, you end up with a really good area for capital growth. Another thing you look for is walk score, which is the ability to walk from your property to transport, restaurants, especially in convenience. So let me ask you a rhetorical question. Do you believe people will pay a premium for the ability to walk out of their house and go and get a coffee or go to a restaurant and walk back? Absolutely. So if you look at walk score, that's a ranking from 0 to 100 in terms of how convenient the suburb is located and how easy it is to walk out of your property and access transport, especially restaurants and cafes. And if you look at walk score, that particular time that was captured, that varies. It's an international way of ranking cities, by the way. You can just jump on walkscore.com and check it out for yourself. South Yarra ranked #1 in Melbourne as with the highest walk score of high 90s, and Hallam had the lowest one, which means in Hallam you can walk around all day and not get a coffee, where in South Yarra you can walk out 5 minutes of your house and you probably get access to about 100 coffee shops. So Carlton, if you look at the highest walk score suburbs in Melbourne, this is another indicator to look for, because ultimately people will pay for convenience. You know, people love living near Fitzroy Street, Brunswick Street, you know, main streets where there's a lot of culture and cafe culture and accessibility to restaurants, etc. Carlton 97 walk score out of 100. Fitzroy 96, Fitzroy North 93, Melbourne 93, St Kilda 93, South Yarra 92, East Melbourne, South Melbourne, Collingwood, Windsor. Have a look at the lowest walk scores in Melbourne. You know, Croydon North, Lilydale, Endeavour Hills, Atwood, Mount Evelyn, Rosebud West, Roxborough Park, Belgrave South, Narre Warren, Derrimut. Now, is there a correlation between walk score and median price? There is. If you look at the top suburbs, in most expensive to least expensive, you can see the walk score is very high, way above 70. If you look at the cheapest suburbs in Melbourne, Frankston North, Dallas, Werribee, look at the median price, look at the walk score. You know, people ultimately will pay for convenience. That's the reality. So what I'm doing is I'm teaching you guys about methodology and how to overlay all these different things over each other to just narrow it down to a small section of key suburbs. And these suburbs have done, Kew, for example, from 2001, 2011, has done 366% in growth. Malvern East, Ivanhoe, Baldwin, you know, all these areas are in the south, southeast Bayside. So where are all these areas located? In the red section. So let me ask you a rhetorical question. How many people believe all my properties that I have are currently in the red section? Yes. Let me ask you another question. If you want to have high capital growth on your next purchase, given that the best schools in Melbourne are in the red section, you've got predominantly white-collar workers who are not susceptible to high unemployment or manufacturing, best transport, best schools, best restaurants, all in the red section. Why wouldn't you invest in the red section? You know, why would you go 50 k's outside the city and invest in an area where there's no capital growth because someone says it's got the fastest population growth and got massive billions of dollars in infrastructure going in? So what factors really determine and drive property prices? Location, location, location does not determine high capital growth. If that was true, South Bank would be the most expensive suburb in Melbourne because it's on the water in the city. It doesn't get any closer to the city than South Bank. Population growth and infrastructure investment alone doesn't determine high capital growth. That's a lie as well. Ipswich has billions of dollars going into it and it's done nothing for the last 10 years. If you look at mining towns like Gladstone, there was over $60 to $90 billion in infrastructure projects going into Gladstone, and the median price is I mean, it's just dropped down from, you know, average house went down from 600,000 to 250,000. If you look at the Australian largest growth suburbs, not Victorian, in Australia, Cranbourne East is the fastest growing area in Australia. South Morang, Epping, Point Cook, you know, Truganina. What's the capital growth of these areas? Nothing. You know, that's the reality. Population growth doesn't equate to capital growth. These are all first home buyers, low incomes, buying houses around 550, you know, 450 to 550, with no secondary market, no exit strategy. That's the reality of the market. And this is why when you're reading stuff about, oh, Cranbourne's got the fastest fastest population growth in Victoria, or Wyndham's the fastest growth area. Yeah, that's true, but what does that mean? It doesn't mean you're going to make money in the area. It just means that there's more people going into the area than ever, but people by themselves don't create an environment for capital growth appreciation. Remember, these areas have the lowest capital growth. Melton is the fastest growth area in population growth. It's the lowest capital growth area in Melbourne, and it's in the so-called Melton Growth Corridor. You know, that's the reality of the situation. And stats don't lie. This is from RP Data, guys, and Domain. You know, so you can check this out for yourself. So all I'm trying to do is save you all that headache and pain of buying these properties, buying a 4-bedroom house in Point Cook, and then 5 years later wondering why you got no growth, versus buying something better, if it's an apartment in an area like, you know, Hawthorn, and then getting that 7% growth every year, and able to then leapfrog from one property to another. Scarcity and high demand, and this is the key, by the right demographics, which are high income earners, determine high capital growth, or the level of capital growth. So you got to have scarcity of properties, no listings, no properties in the market, huge amount of people wanting them, and they have money they can spend on fighting each other to get them. You know, that's the reality. So what type of properties should we be targeting in Melbourne? Melbourne townhouses are the best properties to target, mainly because the top 20 suburbs, you're pretty much priced out of the detached housing market, because most of those areas you got to have a $1.5 to $2 million to buy a detached house. Your second best thing to do is buy a 3-bedroom townhouse where you're capturing the convenience of the area, but you're basically buying a house with no backyard. That's the reality. So townhouses are your #1 wealth creation vehicle in property investing, full stop. You know, they're superior to apartments because they've got a land component, especially 3 and 4-bedroom ones, and you can build them in established areas, and people will pay a premium for them, and they tend to have a better resale value than apartments in terms of owner-occupier sentiment. Apartments are excellent though, and I buy apartments. I'm going to show you one development specifically. I'll pick it apart and show you why I invested in it myself. But you just got to be very wary with apartments. House and land, complete disaster. You know, it's not only that you'll lose money, you're guaranteed to lose money. Not only that, you're going to go backwards in terms of capital growth, because most of these areas perform under inflation. But the biggest thing is, in any volatility in the market, these properties have the highest volatility. You'll never get your equity out of these things. I mean, that's the challenge. In terms of value for money, they're the best. You get a massive house on a massive block. They look fantastic, you know. But this is the thing where you got to detach yourself from the transaction. Yes, a 4-bedroom house with a double lock-up garage from Metricon looks 10 times better than a 1-bedroom apartment in Richmond. But the 1-bedroom apartment in Richmond will always outperform a 4-bedroom house built by Metricon in Melton. And that's the reality of it. 50 square meters of 1-bedroom apartment will outperform 280 square meters of Berwick 4-bedroom houses. That's the reality, and that's based up by stats and valuers. And that's what I want to get through to all, especially investors starting out, because a lot of people don't want you to know this stuff because they're selling these properties. A lot of people have a vested interest of playing around with statistics to make sure you guys think that these are actually good investments, but they're not. You know, so there's a lot. Remember how many people are making money out of this thing. Not only agents are making out of this money out of selling, you know, Point Cook and Berwick and South Morang. The building industry is massive. They need to continuously create these houses because there's a lot of money at stake, and also the amount of labour that is employed to create these estates. I mean, it's huge. So they're going to do everything they can to present you with information that's going to make you think these are actually good investment vehicles. The reality is they're not. Let's talk about my company a little bit before we close up, and I'm going to show you a couple of examples of what I consider really good investment opportunities and what we do as a company, and some of the methodology we use to shortlist our projects for our clients, and how you can take advantage of and benefit from our service as well. Investors Prime Real Estate is the only real estate investment sourcing specialist in the market currently that I'm aware of. Maybe there's another company somewhere out there. I've never heard of them, but I'm saying as far as I'm aware, no one does what we do. We only source investment properties in blue chip areas in Melbourne, based on my 46-point due diligence criteria. If a builder comes to me or a developer with a suburb that doesn't fit my criteria, I will not sell properties for them, irrespective of what the commission is and how good the property looks. There is nothing that anyone can do to make me sell a property, you know, in Pakenham. It's just not going to happen, you know. So I target the suburb first, and then I target builders in those suburbs, and I source properties directly from builders and developers for my investor clients. I only deal with investors. I don't deal with owner-occupiers at all. So once I identify the area for capital growth, then I go directly to builders, developers, and get access to properties. As an individual, I only do about 100 maximum transactions in 1 year. I've got access to over 4,000 properties at any one time. So I've got a massive amount of projects that I've got access to, and I pick and choose the best properties for my clients based on their unique plan and their methodology that they have settled on based on their plan they've developed. I've also have access to off-market developers that will never hit the mainstream property market or be advertised to general public in any way, shape or form. Many projects that I've sold were sold between me, developers, and end investors. They never ended up on realestate.com or domain. There's no boards on site. There was nothing. You know, think about have you ever driven through a suburb and suddenly there's a house being demolished and there's 4 townhouses being built and you never even knew it was happening and the local agents didn't know about it? That's what an off-market transaction is. It's completely off-market. I negotiate very special deals and discounts when I can for my clients. Currently there is no discounts because we're at the peak of the market. Developers are not silly. They can sell anything to anyone. I reject 95% of all investment properties offered to myself and our agency because they don't meet my stringent sourcing criteria. And obviously I'm an investor. Apart from being a real estate agent and mortgage broker, I'm an investor who looks at everything purely from a money-making angle. I'm not a real estate agent. I am a real estate agent, but I'm not a real estate agent as a career choice. I have to do it because it's illegal otherwise to sell properties. If you're not an agent, you'd be in breach of the Sale of Land Act. But I'm not a guy that said, oh, I want to be a real estate agent and make money selling people's houses. No, I had to be a real estate agent because I couldn't buy my own properties or source for my clients. And I offer an unbiased education. I can sell properties in any suburb in Melbourne. I've got no affiliation with any developers. If I don't like an area, I'll tell you about it. It's that simple. You know, I don't care. Some people will find it offensive or that they won't like me. It's not my business. Here's my macro level due diligence research. I won't go through all of it. It's another webinar. Probably I could spend a whole day on this. The first thing I look for is income demographics in the area. I look at how much money people make in the suburb per household on average, and it has to be higher than the national average. Then I look at the capital growth history of the area, last 10 years, last 20 years. I need 10% growth. Then I look at the proximity to the city, because Melbourne is priced by the distance to water, distance to the city, and schools and amenities. Then I look at transports, freeways, infrastructure, primary schools, secondary schools. I look at vacancy rates, rental demand. Vacancy rates have to be below 3%, high rental demand, volume of stock being offered by the developers. Like, for example, South Yarra used to be a good area. Now South Yarra is not a good area. It's oversupply with apartments. Still good for houses, though, and townhouses, but not good for apartments. So volume of stock coming onto the market is very crucial. And also the housing strategy of the council for the area. For example, Altona North, the council wanted to bulldoze the whole suburb, redevelop, and just put townhouses everywhere. If you drive through Altona Beach, Altona North, Newport, you drive through, every second house now is a brand new townhouse because the council wants to rejuvenate the area and they want more younger people coming into the area. That's the opposite of, for example, Brighton or St Kilda. The council doesn't want any developers going in there and they are hostile towards developers. The more hostility there is, the more scarcity of stock. Albert Park, Middle Park is a perfect example. They're 1K from the beach, 2Ks from the city, should be all high density, but the council won't allow it. Everything's 2 levels maximum. So if you look at those areas, I look at the housing strategy of the council for the area and how restrictive it is to build new stock. The more restrictions, the better. Then micro level, that's property specific, I look at the cost per square metre compared to the selling stock in the area. As an agent, I know the cost per square metre of virtually every area that I source in. So to make sure that I'm not overpaying. The size of the property, how it's relevant to the demographics and the needs of the area. Look, every area has different needs. St Kilda is very good for one-bedroom apartments. Donvale's not. Donvale need a 5-bedroom house on 1,000 square metre blocks minimum. Size and type of project and its suitability for the area and demographics, that's the key. Ultimately, you got to identify what people want in the area and give it to them. The layout and configuration of the property, the level and quality of fixtures and fittings through the property, the builder and developer's experience and track record. Also, the due diligence and research, you know, I talked about this before, but we're looking at 10% growth and we're talking about no lending restrictions in the area, which is also crucial. High income per household, very good rental demands, etc. You know, I've covered most of this stuff already. Here's some current examples of stock that I've shortlisted for my clients. This is a boutique development of 6 townhouses in Chelsea on the beach side of the highway off the plan. The beach is literally at the end of this street, and this is the the level of the top townhouse overlooking there. You can see the water in the distance. So it's only 6 townhouses, property price $645,000, 2-bedroom, 2-bathroom, 2 levels, 1-car garage, construction starting in mid-2017. That's a really good development for the area for the price point. Another area is Edith Vale, where these are 3-level, beautiful townhouses, 709,000, 4 bedrooms, 3.5 bathrooms, 3 levels with private lifts and double-car garage. Very good value for money. Construction has commenced already on those. This is another development in Ascot Vale. I've just sourced this last week. Ascot Vale, good area for capital growth. Once again, boutique development, only 8 townhouses, 998,000, 3-bedroom, 3.5 bathroom, 3 levels, 2-car garage. Construction commencing 2016. What about Melbourne apartments? You know, you hear all the negative stuff about the oversupply of Melbourne apartments. Be careful with Melbourne apartments, you know. Yeah, there is an oversupply of Melbourne apartments, but everyone says be careful. It's a trap, you know. This is only for those Star Wars hardcore fans who understand this little joke. Yeah, there is an oversupply of Melbourne apartments in key suburbs. In fact, there's 13,000 apartments being constructed right now or waiting approval in central Melbourne. There's over 60,000 apartments that are actually on the plans for future Melbourne growth. And realistically, we need it. You know, it's a sign of maturity for a city. Will I ever invest in them? Not in a million years, because there's no growth there. Most of them will be sold to overseas unwary investors in Singapore and China. You know, there's 6,000 apartments in the city itself at South Bank. And if you look at the areas, you've got, you know, this is like Spencer Street. Have a look at the amount of towers they're building in Spencer Street. It's incredible. You know, just in the west end of the city. I mean, we're talking about hundreds and hundreds of apartments. Some of these towers have, you know, 500-600 apartments. You know, look at tower number 1, little Lonsdale Street, 212 apartments. But look at little Lonsdale Street number 2, 504 apartments. You know, it's just crazy. But I like it. I think it's great for the city. I think long term, it's a sign of maturity. You know, Melbourne needs to step up. I mean, we're voted the most livable city in the world 4 times in a row. Let's show the world that we are the most livable city in the world, and this is part of it. Part of it is high density living in the city areas. You know, Mr. Guy said people were complaining about overdevelopment in Melbourne. He was saying if Melbourne is too successful, maybe they should move to Adelaide. I agree completely. If you think Melbourne's going too fast, go to Adelaide. Nothing's happening there. City of churches. Yeah, so if you look at the blue towers in Melbourne, there's going to be thousands of apartments hitting the market. The banks now don't want to lend money to foreigners. So there's going to be thousands of these things also defaulting and not be able to settle. But that's got nothing to do with the suburbs that I focus on or source properties in, you know. The reality is that this market, and one of the things I look for is coming from a banking background. If you look at the blacklisted suburbs for lending in Victoria, you look at postcode 3,304, which is Melbourne Central, World Trade Centre, South Bank, South Yarra and Docklands, and South Melbourne. Don't invest in those suburbs. Now, South Melbourne and South Yarra used to be great for apartments. Now they're blacklisted, which means you've got a lending restriction of 60, 70, 80% LVR, depending on the type of property, which means you can't get your equity out and you're going to have problems getting money in that particular suburb. So the banks are actually telling you to a large extent where to invest and where to stay away from. This is a really good project. So where do you invest in apartments? This is the key thing. This took me 10 years to understand. There has to be a 3-to-1 ratio between the price of a house and an apartment for the capital growth to occur. What I mean by that is this. In Toorak, an average detached house is about $3 million. Average apartment, 2-bedroom apartment, is $672,000. So that's a 3.4 ratio between the house and the apartment. St Kilda West, $481,000 for a unit, 1.7 for a house. So you've got to have areas where there's a 3-to-1 ratio between the price of a 2-bedroom apartment and a house. Where apartments don't work is places like Mitcham. You know, your average 2-bedder is $550, average detached house is $750. Why would you buy a 2-bedroom apartment? You can buy a 4-bedroom house on a big block. You never get the rental. Why would you even rent an apartment? You can rent a house. So where they don't work is fringe suburbs and areas where there's low, medium prices in the suburb. And that's where apartments go backwards. Places like Dandenong, places like Caroline Springs, they're never going to work there, you know. Don't buy apartments in those areas. So if you buy a $500,000 apartment, houses in the suburb have to be 3 times more worth than your apartment, minimum, to make it worth. Wow, that's the reality. Now, I'll show you... I'm going to show you a specific development. And this is the thing, you know, there's so much stock out there, but I'm going to show you a specific development. And this is also a strategy where clients have done where they've actually used this strategy to buy property with no money down, which is not a guaranteed strategy, but it's something that you can do as well if you want to take a bit of a risk. This is in Glen Iris, and it's a development called Vivid, corner of Burke Road and Melbourne Road. And this development is currently being sold at a wholesale price, and I'll talk about why it's actually like that. It's a very good development. I know the builder quite well. We've done a number of projects with him. It's the highest density project that I've ever been involved with. It's 48 apartments. Normally most apartments that I sourced are about 12. The lowest one is 7, which I currently have in Brighton, which is 7 apartments in one development. This is 48, but it's amazing views, amazing construction. And here's the thing, this is an off-the-plan long-term strategy settlement. This development consists of 1- and 2-bedroom apartments, superior fixtures and fittings, great views, prices from $435 to $795. Now, construction's already started last year, and it's commencing late next year, so mid to late next year. So you've got massive stamp duty savings still available. Glen Iris is one of the top suburbs in Melbourne. You know, you're looking at 10 k's from the city, southeast, great schools, predominantly white-collar workers. It ticks all the boxes. Median price of the average house is 1.6 to 1.9 million. So you got the 3-to-1 ratio. But the project is selling at 7,500 square metre to 8,500 square metre, where the average project, new project in Glen Iris is already selling 10,000 square metre to 11,000 square metre. What does that mean? That means a 50 square metre 2-bedroom apartment is already selling for $550 to $650, $750 in Glen Iris. You know, these ones are much cheaper. So you've got the 3-to-1 ratio between houses and apartments. You can see that Glen Iris, 508,000 for 2-bedder, 1.6 million. So you definitely have that 3-to-1 ratio in the area. Great capital growth. You know, you're averaging your 8 to 10% growth. But the other thing that's happening, which is unique, is that and I'm not sure if you're aware of this is part of the Andrews government election promise, is they're relocating the train lines and removing the crossings and putting the train underground. And it already has happened in Glen Iris. In fact, the train line is already underground if you go through the intersection now, corner of Burke Road and Melbourne Road. Now, when this project was already priced originally, it was priced at a discount because they factored into the fact that there was a train line behind the property creating noise. Because the train line is now underground, the property prices were fixed over 2 years ago. You're still getting prices from 2 years ago with a train line above ground. So it's really, truly a wholesale price property. The idea is to settle the property by obtaining a loan based on the new valuation, which is higher than the old contract price. So, for example, if you were to purchase a property in 2015 or 16 for $600,000 based on 8% capital growth per year, In 2016, the property will be valued at $648,000. 2017, another 8% growth, $699,840. So the strategy here is to create a 10 to 20% gap during the construction phase of the property. And then once the property is valued at $699,840, you take out a 90% loan against the new valuation, which is $629,856. And you originally paid $600,000, which means you've got 100% settlement, including stamp duty. Now, it doesn't always work that perfectly, but this is one strategy that I've been doing quite successfully, and I've secured the property in this project just so I can settle with no money down. The property prices are $545 to $620. This development will complete next year, end of next year. There's only 5 available that are left. There's only one two-bedroom apartment left in this project. The rest are one-bedroom apartments. If you're interested, by the way, you can just SMS me or email me, and I'll send you the plans and due diligence about that project. That's pretty much it, guys. I hope you enjoyed the webinar. I went over time a little bit. If you are interested in furthering your education, I encourage you guys to join me live with Cameron Fisher from Changing Places Real Estate and the director of buymyplace.com.au, just listed on the stock exchange, and Stephen McClutchy from Loans Australia, probably the most senior, I would say, and experienced mortgage broker I've ever had the pleasure of working with. The guy has settled over $1 billion worth of properties himself. Amazing guy, lots of knowledge, and myself, and spent 2 days with me and a bunch of other experts at the Real Estate Investing Fast Track Weekend on the 30th and 31st of July 2016. There's only 12 seats left in that particular event, and it's 2 days of just pure content and information. And I mean, tonight, think about how much you've learned over the last 1.5 hours. Imagine that over 2 days and spending 16 to 20 hours with myself and a bunch of other experts. So if you're interested in getting some tickets, just simply go to realestateFastTrack.com.au. It's 2 days. Day one is basically finance and how to structure your property portfolio correctly. You also learn the proven method of how to pay off your current 30-year principal interest mortgage in 15 years or less, saving yourself tens of thousands of dollars in unnecessary interest repayments. Day two is all about research and due diligence, which is incredible. You see, it's one thing to be educated in a classroom environment. It's another thing to go out on the road, in the bus, and spend a whole day with me and a bunch of other experts, including a valuer, looking at properties and picking apart projects and looking at the good and the bad, the ugly of different areas, and then micro-level research and looking at specific projects. This is priceless. Now, tickets are originally $97, but if you go there right now, tickets are free. Also, for those who would like to buy my book, you can check out my website, bookonfinance.com.au, or simply go to Amazon. You can get a Kindle version for I think it's like $10. Hard copies around $30. Highly recommend it. You're going to learn a lot from that book. It took me 3 years to write, 10 years of knowledge in that book. As I mentioned at the beginning, your special bonus, which is available for everyone listening to this webinar. Normally this is a recording of the event, and it's valued at $497, and it's yours absolutely free. Now, I'll show you what you're going to learn at watching this video course, and I'm going to show you how to get access to it. So you're going to discover advanced property investing strategies and learn specific real estate finance and due diligence methodology will give you the confidence and skills to start building your property portfolio as soon as you leave the event or watch it online. One of the key things is the hardest thing about investing is to get started. You're also going to learn insights to understand property cycles, state by state, where exactly we are, and more importantly, how to get the information independently. Because I'm going to teach you how to fish at this event, how to identify the exact type of properties, house to land, townhouse or apartments that are relevant for different areas. Also, how to pay off your home loan in 10 years or less, with restructuring your finances. And also how to structure your first investment property acquisition. I'm talking about trust here, of course, whether you should be buying properties in trust on your own name. Don't get that wrong. I'm also going to teach you the formula the banks use to work out how much money you can borrow from them, which is called the DSR ratio, which is one of the most important things you can learn as an investor. You'll learn 18 powerful ways to supercharge your borrowing capacity, 19 critical questions you need to ask your mortgage broker in order to qualify them whether they should be working with you, 12 most common deadly property finance mistakes, and they can avoid them, and also the importance of balancing your property portfolio between cash flow positive and cash flow negative properties. Plus, there's buckets of load more information. So this is what it looks like online. It's literally you go in, you register, and then you get a members login section. And it's literally just videos and a manual. And it's absolutely free, no strings attached. So you basically get access to the whole thing instantly by going to that link, realestatetdvd.com.au/absolutely-free-access-2016. 10 hours of video plus a 265-page manual, which covers so many areas. You know, tonight I just scratched the surface. I mean, this is a very, very comprehensive home study that really teaches you how to do this stuff from scratch. Also, I'm going to email you a replay of this webinar as well. So if you're registered, you're going to get this link with the replay of the webinar, and you're going to get a link to my free home study as well. So don't worry if you didn't have time to take down that URL before. You're going to get an email where you can just go in and then just watch the whole thing online. And that's about it from me for tonight. It's been a pleasure spending this time with you. For those who have any questions, now is the time to put them in. For the rest of you, it's been a pleasure spending this time. I hope you're successful in your property investing in the endeavors in the future, and I hope to see you live at a future event.